All right, good afternoon. Pleased to kick off our next episode of Lumina Non-Consensus Investing. We are live. I'm with Ben Forman from ParaFi. Ben, like me, is a TradFi digital asset crossover. He's got a great background that it includes KKR, TPG, Sixth Street, and he leads ParaFi. They've been a leader in digital assets for quite a while. We wanted to focus today on stablecoins. Stablecoins are really all the rage, and you're seeing the success of stablecoins and public market offerings. You saw the Genius Act was passed by Congress a few weeks ago. SEC Chair Paul Atkins was commenting on how digital assets can transform capital markets. There's a lot to get into. There's really no better person to dig into it than Ben. Ben, thank you for joining us. I noticed, by the way, that you were UPenn and you were philosophy and economics major. So was I, actually. So it's really funny. It's great to see that and see you get into space. Before we get into stablecoins, how did you get into digital assets? How did you make this leap from hard assets, free cash flow, and yield into digital assets?
I actually ate lunch at the Coinbase cafeteria in like 2014 when it was I think it was like a Series A or B company at the time, and I had a couple friends that were interviewing for jobs there, worked there, and I had prior to that I had bought Bitcoin, but that really kind of like accelerated and piqued my interest. This was like kind of my nights and weekends hobby while I was doing traditional credit investing in traditional industries while at KKR. But I just kind of completely caught the bug, and I pitched KKR to buy crypto, actually to buy Bitcoin specifically in 2015, back when it was trading at $200 to $300 a coin. And I would say like
It didn't take a while.
yeah, eventually they came around. But at the time, actually, during a discussion, I think like I presented to 25 people, and I think 23 said they would short, Bitcoin. And me, myself and the summer intern at the time said, we would go long. But that was my first kind of interaction with Bitcoin and how I got into it. And then with the ICO boom in 2017 and just the industry growing and smart contracts executing financial logic and stable coins, I kind of came to this fork in the road where I said I could either continue to do traditional investing in credit for the rest of my career, or I could take a leap into the wild west of crypto. And I chose the path less traveled by, and that's kind of made all the difference in a way. But what's really interesting now, and I'm sure we'll get into it, is the paths are reconverging. Like they diverged. There was crypto and traditional markets, and now they're kind of coming back together in areas like stablecoins, tokenization, DeFi, digital asset treasuries, and many, many, many more use cases like prediction markets and so on. So the worlds are really like one and the same now, which is fantastic to see, because I think like crypto is just like increasingly more difficult to ignore. It's increasingly just relevant. I don't think today you can be a bank or a fintech company and just ignore the space. And all the biggest players, like whether it's PayPal or Robinhood or Adyen or Nubank or Revolut or JP Morgan or everyone is doing is probably the most active they've ever been in crypto. Like without that there's no subjectivity to that statement. Post Genius Act, there's just been a flurry of activity. So that's what gets me kind of very excited.
The banks are quote unquote frantically getting after this opportunity. What an incredible lunch at Coinbase. Back then, there would have been a lot of career risk talk about Bitcoin. Actually, not really, because it didn't even really exist as a concept. Now there's career risk if you're not in digital assets. So let's double click into stablecoins. I saw you present at Decasonic. I had already had an espresso, as I do every morning, and I already been enthusiastic around stablecoins and what does this mean for the future of capital markets. And I saw you speak, and I felt like I had a double shot espresso right there. I really got to get Ben on the show. So tell me, why are you excited about your stable coins and what the Genius Act unlocks for us?
Yeah, so I think stable coins are, not only like a new kind of like financial primitive, but they have, what's really interesting about stable coins is they are like a geopolitical phenomenon, like a socioeconomic phenomenon, a technological phenomenon, and they're really poised to kind of like reshape uh, the way we use money and the way money moves and the way we kind of think about the risk behind money. I think there are a few different dimensions to this. One is this idea of like a stable coin is really M1, it's not M2. So if you think about like checking deposits in a commercial bank, those your deposits are relent and rehypothecated many times over. But what's interesting about stable coins is they're basically like tokenized treasuries, which I believe is you're one-to-one collateralized. So that is a much safer, like kind of like legal structure for money than taking kind of effectively counterparty risk of a non-systemically important financial institution like a community bank. So it's really like it's just as much, I think, a legal innovation as it is a tech innovation. So, but look, I think at its core, look, the most popular consumer product in the world is the U.S. dollar. Like America's biggest export is the dollar. The dollar is used in 70% of all global commercial transactions. And I think like what's very interesting about stable coins is they are kind of like reinventing that market. So today, if you look at stable coins, they're about a $265 billion market. That's up about 60% year over year. Tether today became the 14th largest holder of U.S. Treasuries.
Wow.
These
a
are
non-bank that the Department of Homeland Security was focused on is the 14th largest holder of U.S. Treasury. Can't make this up.
Like it's really interesting because Tether is like almost like I kind of think about like stable coins in large part as euro dollars. So like idea of a euro dollar, like it's a dollar deposit held outside of the US. So that's not subject to US legal or banking regulations and can be accessed by, whether you have like a multinational in, a multinational oil company in the Middle East that maybe wants to hold dollars outside of the US, or a Chinese business that wants to, transact in dollars and hold dollars outside of the banking system. They can now do that with something like USDT. And that's why you're seeing, USDT adoption just take off in, the Middle East, Africa, Latin America, all throughout, Asia. Southeast Asia is a huge hub, and it's all Tether, and it's not USDC.
Right.
And these, kind of the uptake has been incredible, and the network effects are very, very strong. And the euro dollar market today is roughly $13 trillion. So there's actually more the total euro dollar market, which is dollar deposits held outside of the US, is actually greater than all commercial checking deposits inside of the US. And so Tether has really, just dominated that market. It's very much a monopolistic business because money is a network effects phenomenon, and there's a lot of path dependency. Mm-hmm. And then Circle has basically been dominating a bit more in B2B use cases, and as well as in I would say more like US centric payments and financial institution use cases. So look, like I think that like what is interesting to me about stablecoins as well is it's not really a technology bet anymore. It's really more just the technology's kind of been built. Like it will be improved incrementally, but the idea of moving a dollar on the internet has never been easier due to stablecoins. And it's very much now a go-to-market play. And if you look at all the data and like dig really deep into the data, I mean, most stablecoin related KPIs are growing at compounded annual growth rates of 100 to 200% year over year. So one great metric is the number of wallets that send a stablecoin in a given month. Last month was about 42 million wallets sent or received a stablecoin. If you look at that number, 42 million, that's grown every single year since 2019. And it's grown at about 150% compounded annual growth rate. So this is a secular trend. Like people think about crypto as cyclical because the prices are very volatile, but stablecoin adoption is secular. The other really great like metric is that the average wallet last year in 2020, this is 2024 versus 2023, the average wallet in 2023 had 9 stablecoin transactions a month. This in 2024, the average wallet had 13 stablecoin transactions per month. So not only are there more wallets using stablecoins every month, but they're actually using them more often. And then if you look at kind of like the dollar volume that's being sent, if you look at like all the different types of use cases for stablecoins, whether it's card-linked payments or B2B payments or remittance, like all of these things tend to be very much up and to the right, which is you kind of think about a world in a few years where there could be, instead of 260 billion of stablecoins on chain, 2 trillion of stablecoins on chain.
That's talked about $1 trillion plus. He sees that potential U.S. a source of funding for treasuries. Let's start with the macro piece, and we'll get to the company level winners and losers after that. You start off by saying, hey, look, stablecoins are fully backed by a dollar. In a way, we're getting back to classic banking. The original function of banks were to perform custody and not rehypothecate. Of course, here, those dollars are held at banks, and banks continue to perform credit creation. Do you see some changes in how banking and lending transforms as a result of stablecoins, right? Think about how you're allowing deposits to move frictionlessly 24/7, nights and weekends. Banks aren't accustomed to that. Of course, we saw this very sharply with Silicon Valley Bank, First Republic Bank, back in the 2023 kind of banking crisis. What are some of the kind of macro changes and impacts to credit and lending, if any, that you might expect?
Yeah, I mean, this I think is like probably one of the most important and fascinating questions that can be posed at the moment. Look, I think that what you're going to see is so just to kind of put a nail in it. So if you have a stable coin, it's backed by a treasury and it's basically fully collateralized. That from first principles, I think is like a safer form of money, and also a more efficient form of money because it could be moved around 24/7 than holding a commercial deposit with, say, like the 50th largest bank in the US or the 200th largest bank in the US. I mean, maybe the top 5 systemically important financial institutions that have that implicit government backing, you could argue are, it's as safe or safer. But I think like what we saw in the kind of like banking crisis, like during SVB, it was almost safer to hold the USDC than it was to hold, to have like your deposits at SVB over the weekend. And I think that like one of the elements here is like, so if you think about USDC, the vast majority of the funds are basically treasuries that are managed by BlackRock, that are custodied by BNY Mellon. There is some cash reserves, and those cash reserves are in the form of bank deposits with several large banks like JP Morgan. SVB was actually one of the banks, and that's why USDC depegged to 88 cents. And the reason why you can't be 100% in treasuries is because you have to be able to process redemptions. So what's really interesting here is, I mean, USDC is actually or Circle has been public about basically wanting to have a direct checking account with the Federal Reserve, where basically the reserves for USDC would be twofold. One, treasuries managed by BlackRock, custodied by BNY Mellon, and two, demand deposits with the Fed.
That's
And
better than FDIC insurance. You have a stronger counterparty and you don't have the 250K cap.
Exactly. So you don't have to you don't have to manage around like FDIC limits. So I think in a world where you have that, I think that's just like a better financial product than what banks can offer in a checking account.
100%. Is there a negative impact to credit creation though? As you know, banks create new money through fractional reserve banking. If everything's fully backed by treasuries at a custodian like BlackRock, BlackRock's not turning around and then investing in Main Street by providing loans to small businesses. How do you see that playing out?
I think that look, it's a great point. So I do think that banks' role in credit creation, if you kind of like look at where the puck is going, I think it will be diminished. And I think shadow banking, so, the big alternative asset managers, private lenders will kind of fill in the gap. And you've kind of already seen that, happening. I think the flip side to this is that as stablecoins grow, every stablecoin that's issued buys basically $1 of treasuries. And so stablecoin issuance is very, is ultimately brings down the government's borrowing costs and cost of capital. By bringing down the government's borrowing costs and cost to borrow, that's basically the benchmark rate for all fixed income. So yes, like banks' role in credit creation will be diminished, and kind of the shadow banks will have to fill in the gap. And that could cause interest rates to blow out in the short term. But on the offset, like you have stable coins that are kind of lowering the risk-free rate, which should also be, and you have a lot of the stablecoin growth has come outside of the U.S. So there's a bit of a put and take there. But I do think if we look back in like 5 years or 10 years, I think that the whole nature of credit markets are going to be materially different because of stablecoins. And I think the role of like the long tail of, I believe there are roughly, I think there are more banks today than in the US than there have been in like a very, very long time. And I actually think you're going to start to see like meaningful consolidation.
Well, there's 4,500 banks today. We used to have 20,000 a couple of decades ago. There's an M&A process that continues within banks. The small banks, they're trying to figure out how to compete with the large banks that have more tech spend than all the small banks combined, right? JP Morgan spends $12 billion in tech. All these small banks are trying to figure out how do they stay relevant. They're using Zelle, which advantages the large banks as well. It's hard to see how they can escape this. They see the writing on the wall, but they just can't execute against a future where the small banks are relevant. But as you know, they play an important role in small business lending where the big banks do not. I mean, you can get a credit card, they'll finance big corporate deals, commercial deals, they'll give KKR a loan, they'll do all those things, but they're just not going to underwrite the pizza shop locally. So I agree. I think any other thoughts on credit? I 100% agree. Your credit markets will be transformed. I don't think people have really thought through how that plays out.
Right. One other observation is that you recently saw JP Morgan dollar is actually a fundamentally different model for a stable coin because they're tokenizing bank deposits. So the nuance there is basically they can take, if you have like $1 in a JP Morgan checking account, like you have a token that represents that checking deposit. Now on the back end, JP Morgan can continue to do what they're already doing from a credit.
Let's play this out. So apparently JP Morgan, Citi, and a couple other large money center banks are contemplating some consortia where they issue a stable coin. That's one concept. JP Morgan might go alone. Citi might go it alone. They have the ability to do that. But in either scenario, though, like if you've got big bank coin, let's call it JP Morgan or consortia, you can imagine a world where there are other banks that are custodying that coin, but they're not benefiting from the fact of the deposit. They're actually helping JP Morgan. JP Morgan's still keeping the deposit. It's just in a tokenized form. It might be sitting in the custody account of a random bank. All to say, if you zoom out, it looks like the big get bigger. The big banks are advantaged further. There's a flight to quality, including in treasuries, which isn't great. Like, we need to see Main Street get funding. That's what Besant's talking about. Main Street and the 493 haven't participated. They're not getting as much access to capital. Capital markets are closed unless you're big and publicly rated and you have an S1 filing. And banks are shrinking and getting smaller that do lending there. So how do you see that? I mean, is this like a big banks get bigger kind of thing, or is there a role for competing issuers to get involved?
I think it's like, yeah, I think there's like a power law distribution of like, already the top 5 banks in the US, I think, control like 85 to 90% of all deposits. And so, look, I think that there's basically the business model for stablecoins and for banking is who captures the net interest margin. And to your point, even if there's like a bank-led consortium of stablecoins and those are custodied by, bank number 500, they're not actually benefiting from that.
Right.
They're not actually capturing the net interest margin.
Right.
And so I think I just see the big banks being like very well, potentially well positioned to capitalize on stablecoins. But I think the long tail banks also don't necessarily have the CapEx budget to build the infrastructure they need to custody and handle stablecoins on behalf.
I don't know how very few will survive in a meaningful way. To your point, the big banks have a path forward. The tech companies, as you know, in the Genius Act, were advantaged versus the banks. It actually advantaged non-banks more than I and many others thought, which is tremendous. It's good for innovation, good for competition, but it was a surprise. But the regional and small banks, we'll have to see. Now, there's probably a role for one of these small banks to play the role of helping the tech companies that don't have access to Fed master accounts and payment rails to compete against the big banks. You need to have some alternative, but that's an answer for one bank or maybe 2 banks, not the ecosystem.
Right.
An infrastructure play. How about in terms of payment rails now? So do you want to walk us through, like, what are the payment rails we have the last few decades? What do stable coins mean for those legacy payment rails and the kind of share shift you might expect?
Yeah. So, I think there's, B2B, there's C2C, so consumer to consumer. There's B2C and C2B, but like, we can kind of put those in a bucket. And then there's like this new letter, A, which is agent. And like, we'll cover that because I think agents are going to be big participants in payment rails.
Yeah.
So I think in the early days of crypto, so like say up until 2021-ish, the majority of stablecoin activity on chain was consumer to consumer. So a lot of this was crypto trading, OTC trading. So like some consumer to business and business to consumer, but a lot of consumer to consumer. And there were some like peer-to-peer stablecoin payments in emerging markets, almost like Venmo-like transactions, where local economies were dollarizing. And then the other bucket that saw some traction was just cross-border consumer remittance, where if you look at MoneyGram or Western Union, the amount of economic abstraction along those rails is absurd. Probably some of the most. It's absurd. Right. Yeah. So we're talking like if you're spending $100 from like Los Angeles to like Manila in the Philippines, you're looking at like maybe like 5 to 7 business days to settle, somewhere like 8 to 12% fee. And it's also not a great user experience. Like you have to go to a branch, like your loved one in the other country has to go to a branch. Like, yes, there's some like mobile tech that they're developing that makes it slightly easier, but these rails like have not changed in a very long time. So I think stablecoins are a 10x improvement on those like consumer remittance cross-border rails. Similar on the B2B side. So the average B2B cross-border transaction goes through 2.6 correspondent banks. takes about like 3 to 7 business days to settle, and the roughly average fees for B2B is roughly like 4%.
Insane.
The B2B payment channel is also orders of magnitude larger than the consumer to consumer payment channel.
Great point. Great point. I mean, people aren't focused on that. A lot of entrepreneurs lined up outside the OCC. There's 200 entrepreneurs applying for a fintech, for an OCC charter, a national bank charter. I doubt many of them are looking at the B2B angle.
Yeah, and the B2B angle is interesting. So the other really, one of the companies that recently that Stripe recently acquired, called Bridge, they were focused effectively on servicing corporate treasury. So if you think about a company like SpaceX, they're paying contractors in 140 different countries, and they'd have like local FX in banks in all these different countries and have to manage working capital in these regions. And there was a lot of operational complexity associated with that.
Right.
So with stablecoins, well, one, you can give your contractors or customers the option to receive dollars very, very easily. And many of those contractors or employees prefer to receive dollars. And Bridge made it really easy to basically, for a large corporate treasury, to send stablecoins without interacting with wallets and blockchain. So it abstracted away the complexity and made it really simple to send thousands of transactions a month in dollars to your.
So Bridge, I believe, is founded like, I want to say 22. It was bought by Stripe for $1 billion. I think they had like 10 million in revenue, which implies 100x price to sales. It might turn out to be like the Instagram acquisition that Zuck did, where in hindsight, it was an amazing deal. Even at the time, it seems like they overpaid. They also acquired another stablecoin company. Let's get into winners and losers now. Is Stripe a winner, loser, or neutral, or kind of unclear here? How would you score them?
Well, but by the way, like, I just want to underscore one thing you just said, which is, like every fintech is doing like the buy versus build versus partner analysis. So they're like, okay, we need to get into stable coins. Do we take engineering and product resources internally and like have them build it? That's option one. Do we acquire the talent and bring it in-house? Or do we kind of like partner, not fully build it ourselves, but like partner with some,
rent.
Rent.
They should rent. I mean, it's not their core competency delivering value to the customer rather than innovating on stable coins.
Exactly. So like if you think about, like, for example, PayPal, like they're partnering with, Paxos for like stablecoin custody and issuance. So like that's like one example of like partnering. But you kind of you remarked on like the revenue multiple, and like, yeah, absolutely, it seemed like a very nosebleed multiple. But what we're starting to see is actually the skill sets of like the human capital that knows how to build on blockchain rails and understands smart contracts and understands just like the full architecture behind building on blockchain. It's a very different skill set than people that have been building on like Swift rails their whole career. And so I think the actual like buy decision it's buy or partner. It's really difficult to build this in-house, and you're willing to pay. I mean, because from Bridge's standpoint, or from Stripe's standpoint, I think their latest private valuation may have been like 50 billion-ish. So like at 1 billion, it's like 2% of their stock, to basically acquire like a existing customer base and team in crypto. But I think coming to your question, like who are the winners and the losers? I think that, so I think we covered this earlier. I think the long tail banks, I think there's like a short thesis.
The big banks have a winning position.
I think they have a winning position. Now the fintech companies, I think that it's very dependent on the company itself. So like if you look at a business like, like Visa or Fiserv, or like people that basically are extracting like large rent.
The middlemen, intermediaries.
The intermediaries. I mean, candidly, like the banks make a lot of money on payments. Like I think if you look at, So like the big banks, I think will have some P&L erosion from this, but I think that's where there's the most meat on the bone. So typical like point of sale transaction in the US, you swipe your credit card to pay for a dinner, $100, the merchant gets 98, right? $2 goes to the supply chain of card issuers, the banks, the merchant acquirers, interchange fees, and so on. And so I think that $2 can basically get divided up. So I think some fintechs that don't have, that payment rail, like those fees as like an existing legacy business, kind of stand to benefit from incorporating stablecoins into their core product.
I feel like Shopify, Affirm, Upstart, anyone that's enabling payments, the buy now, pay later, but even merchants just generally, Toast, Checkout.com. I mean, the corner bodega that has a 1.5% net margin because they're spending 3 points on Visa, MasterCard, Amex, and they're huge winners, huge winners, which is great for Main Street. Love that.
Exactly. Yeah, no, that's exactly right. Like, are you someone that's paying those payment fees? Are those payment fees revenue to you? And I think that's like the critical question on winner and loser. And then to your point, like consumer surplus, like, Econ 101, like I think stablecoins will, if the bodega is going from, 1.5% margins to like 3% EBITDA margins, maybe they're giving back some of that to their customers. So I think that, but I think don't quote me on this exactly, but I believe those like kind of the pure payment fees, that 2% is somewhere on the order of like 80 to 100 billion a year of revenue. And you ascribe like a multiple to that, that there could be like maybe $1 trillion of enterprise value associated
Visa,
with
MasterCard market cap plus private companies, right?
Exactly. So that I think has just.
I agree. So I'll take the under on Stripe. I think they've got more risk. I mean, they've got to maintain position. They're like Facebook during the rise of the digital mobile channel. Facebook navigated it, they got it right, and now they're a leader and they're crushing.
Right.
But they navigated that. It's not clear to me. It's not clear to me that Stripe can't get outbeat by another party. No, there was a consortium. It was Libra, then Diem, right? Zuck, who clearly is a crypto native. This guy is obviously a crypto. Anyone who's watching what he's doing, he looks at WeChat and Alipay overseas and says, gee, these are non-banks are enabling peer-to-peer payments on their mobile software, the social media software. Why can't they get in this? They tried with Libra. That didn't go anywhere. None of the governments liked it. Then they rebooted that as Diem, which was compliant. It was fully compliant. We were at Cross River. We were a member of Diem, fully compliant. An FT article came out, said Jerome Powell, Fed chair, said, yes, it's great. Janet Yellen said no, and it didn't happen. Obviously, they could stand to benefit from stablecoins. Amazon, maybe they can get into banking. Amazon doesn't pay the interchange fees. Google, they have consumers on one side. They've got merchants on the other side, but they can't compete with Visa, MasterCard. Do you think there's room or a reboot of Diem?
Yeah, I think there's room for that. I did notice in the Genius Act, it says that you have to be a financial institution to issue a stable coin, which like kind of like leaves
ambiguity, right? Exactly.
Ambiguity around like what like can Walmart issue a stable coin? I mean, one big question is like, does this market for stable coins evolve into a monopoly, a duopoly, which is what it is today, an oligopoly, or just like a fragmented space where like, Walmart has its own private money stablecoin, Amazon has its private money stablecoin, Meta has its own. And, I kind of like come back to, I just don't see, like, for example, if Meta has its own stable, digital dollar, it can rotate between, WhatsApp and Instagram and, the main Facebook app and so on. And maybe they can earn some sort of net interest margin on it, but it's going to move solely in that closed economy because there's no way that like Amazon will want to support. I don't think Amazon will really be interested in supporting like Meta dollars, or Google won't want to support like Meta dollars, and Meta won't want to support Amazon dollars, or maybe like So it kind of just you end up kind of coming back to, I think, more of the Switzerland model, which is, if you look at actually how Visa started. Visa was it was a consortium of the banks, and so it was like very neutral, and they all had like equity stakes in it. And I think that's what's interesting. That is kind of like a bull case for Circle, which is it's sufficiently neutral, so it's sufficiently neutral. So
I think they have more at risk. I think they have, I mean, just given where the price is today, I think what they've accomplished is extraordinary. My hat's off to Jeremy Allaire and the team and Coinbase and Vishal Gupta, who's head of USDC. Like, these are incredible. Like, what they did is extraordinary, like GOAT level accomplishment. But it's a fascinating question. It reminds me of like the free banking period, 19th century. We had Bank of America had their own currency. But then they said, gee, there's issues with interoperability, and we align on a uniform standard, create standards of safety and soundness. There are advantages to having your own economic currency, but either if you have a proliferation, you either get an FX layer to make it easy to swap and transact so the consumer wins, or you have some infrastructure layer on the back end where there's some settlement and swapping through create redeem of stablecoin. There's some infrastructure players that get together to make it easy for the customer again.
Right. And by the way, like what you just touched on is like this idea of this orchestration layer where you can seamlessly swap between Meta dollars and Amazon dollars and USDC and USDT is really like what Bridge was building and effectively will continue to build internally within Stripe. And in a world where you have this heterogeneous like landscape of all sorts of different like private money or privately issued stable coins, like I think that layer could be really, really valuable.
I agree. No, it's a super interesting question. On the former though, like if you don't have a bank chart and you can't access the Fed master account, you just can't move money as quickly, and you're not as high a quality counterparty as others. So Stripe, they'll have to go public just so we get transparent financials, quality credit ratings, and all the rest. They kind of have no choice. But yeah, no, it ultimately plays out with users. What's the best user experience? The user experience, it should be abstracted away from the method of payment. At the same time, though, people are going to want their private walled gardens. Who doesn't like the private walled garden? We had open APIs with Twitter and Meta. They all went away. They said, let's lock this down. Let's control the customer.
Mm-hmm. Yeah, like I do ask myself, like does it make sense just from like a user standpoint to have like, my Amazon dollars, my Meta dollars, my JP Morgan dollar, like 10 different types of dollars, and I have to add them all up and aggregate them. Yeah, it's a fascinating, it's a fascinating question.
How do you see Visa and MasterCard playing out here? Obviously they're a network. They don't do the merchant acquiring. They don't issue the credit card. They're the network. They enforce standards on the network. Their customers are the banks, community banks, credit unions, and merchants. Are they? I mean, look, they're very, very sharp. They're on the ball. They're both doing M&A in the category. They're essentially the reason why Money 2020 exists. They pay top dollar here. So, do you need that network now? They have crypto teams. But it's like if you see the asteroid coming and you're the dinosaur, it doesn't matter. So what? The asteroid hops to like Antarctica. You're still going to get taken out over like a 5, 8, 10 year, 12-year time frame. How do you see their fortunes? And maybe I don't want to put you in a bad spot. Maybe they're an LP or not. I don't know. But
No, I mean, I think they would admit this, that they've built incredible like I think if you look at like Porter's 5 forces or just understand like purely assessing like moats, defensibility, business quality, network effects, margin sustainability.
Yeah, like it's a Buffett quality business. Yeah, it's got
I mean, probably one of some of the better businesses like ever built.
100%.
But I do see this as like a Blockbuster meets Netflix style moment where the like this technology like truly like has potential to kind of completely upend their core business model, and there's a potential they can thread the needle in the same way that, to your point, like when Facebook IPO, people were freaking out about mobile, and like they were able to they were able to like capitalize on mobile and were able to like kind of skate to where the puck was going. But I think it's like a bit more difficult here in the payments world, just given how fast things are moving and how fat and happy those organizations are. I mean, these are not like
Agree.
startups, these are like century old or half century old businesses.
Exactly.
So
Yeah, I mean, regulation has protected them, and Congress and political donations. It is an oligopoly. They've been subject to antitrust almost every 10 years, and they get out scot-free. But now technology is coming after them, and they're well equipped, they're well financed, and they can also lobby and influence. So I agree. I take the under on them on a 8 to 10 year time frame, but they are extraordinarily well managed businesses. They play optimal chess strategy. They know what they're doing.
They know what they're doing. Now, I think like the Western Union and MoneyGrams of the world, like those are not really network effect businesses. Those are
I
just,
agree.
those are more
gone.
commoditized. So I think those are probably the first to see more cannibalization.
100%, 100%. Where are you focused in the ecosystem as an investor now from a digital asset perspective, right? I mean, first off, most VCs I think are off sides. They dismissed or canned their digital asset teams. Most partners, most VC firms probably have not done an on-chain transaction with a non-custodial account. And fintech and crypto were these siloed walls. You could invest in ID theft and compliance protection, and all that is changing due to tokenization. So I think firms like yours are really well positioned. They can be on both sides, and the puck has kind of gone to your area. From your vantage point, what are the areas that you're looking to invest in?
Yeah, so fundamentally, like we invest at the intersection of traditional markets and blockchain capital markets, and those two areas are like very much converging. So I ask myself, like in a world where stablecoins, like maybe in 5 years, are $5 to $10 trillion, and tokenized real world assets, so tokenized stocks, bonds, currencies, commodities, LP stakes, farmland, litigation finance claims, carbon credits, like the whole menu of assets are also tokenized. And by the way, tokenized real world assets are growing even faster than stablecoins from a smaller base, but
Is that right? From a smaller base, right? What's gaining the most adoption of that apart from dollars?
A lot of private credit, fixed income,
like KKR, the Apollo stuff. You think that's real? I mean, I know it's real. It's happening. A comment was made by a partner at Dragonfly, very thoughtful guy. I was sharing your thesis actually. Pulled him aside at a recent conference. I said,
yeah,
look at this. Private credit's going on chain. It's happening. We started with US dollars, zero interest bearing. Then you went interest bearing with treasuries. Now you're moving down the risk yield curve.
Yeah.
And he made a very thoughtful point. He said, if you're on chain, either you're hiding out in stables because you don't want risk and you're maybe doing yield farming there, or you're degenning out on something ultra high beta, ultra high risk. And you're caught in the middle with these private credit. Now, maybe that's a maturity of who's on chain. Although we're talking about a lot of this as an infrastructure layer that abstracts away this on-chain activity. It may not necessarily drive onboarding. How do you think about, how do you respond to that?
Yeah, so I think that's 100% accurate today. So like the demographics of on-chain capital today are, it's like very risk-seeking capital, very like regulatory sensitive capital. It does not want to off-ramp back into the TradFi world. And the demand for like an Apollo, like 11% private credit fund is like very limited. I 100% agree with that. However, I think like that pool of capital, like that kind of on-chain wealth that we've seen generated through the last cycle, it's not growing. There's like very limited organic growth, and it's all like, kind of like affluent-ish, like, accredited investor level people in like the US. And there's some internet, but it's like people that it's a very limited subset of like the
small group of people that know each other on Telegram chats that are building protocols and in networks, and they can trade around that.
100%. By the way, if you look at like the power law distribution of like users using like Hyperliquid or any like DeFi protocol, like it's like you'll have like literally 100 wallets that are like 50% of
Yeah.
all the economic
Right.
activity, and then like
Yeah.
1% of users are like 90% of the
Yeah.
activity.
Yeah.
So
Yeah.
there's probably like 2,000 wallets in on chain that are like driving all the flows.
The Gini coefficient is off the charts, right? It's like Rome, basically. It's ancient Rome on chain.
Exactly. It's like, yeah, it's like the Gini coefficient is like some like,
Right.
exactly. It's very it's extreme. So, but I think that what you're seeing today now with like the Genius Act and all the positive regulation that you've seen. By the way, the Genius Act was like last week on Monday was signed into law.
Right.
So
Right.
this is fresh,
Oh yeah.
like,
And everyone's offside. Like they have no
catalog.
offset. They're trying to figure out what they're supposed to do. Well, what's the next move?
Right. Yeah. And now, like, I mean, the OCC has also said that banks can now hold digital assets and be compliant. And so this is just opening the door for tokenization. Like you saw BNY Mellon and Goldman are partnering on tokenized money markets. I mean, it's very much taking off like today. And I think
Right.
more institutions are coming on chain because you probably saw like the Hester Pierce statement yesterday around, the SEC basically wants to move assets on chain. It's not like, hey, going on chain is like, is
Yeah.
permitted, but like, we don't know,
No,
it's like,
it's like green light. It's like, let's go forward. I mean, the SEC chair is embracing digital assets. I mean, this is
right.
you've never had a regulatory backdrop that's even more favorable. One can't conceive of a more favorable backdrop. They have to move into rulemaking. That will happen. That's the next direction. We're going to see some of that, but the rulemaking will be favorable. Are the
Right.
investment banks at risk? So tokenization is you're wrapping a real world asset on chain, and it's protected by cryptography. So one way to think about it, it's a representation of a real world asset. Now, of course, investment banks are in the business of creating securities. Are they at risk?
Yeah. So I think tokenization is more of a risk to the banks and more of a tailwind to the asset management firms. So for example, like BlackRock, Franklin Templeton, Wisdom Tree, these are all like, they pay millions of dollars to the banks every year to like in settle, like their clients do in settling these assets, right?
Right. The
So
asset managers are winners. They don't have any risk here. They're winners.
they're the winners, but the banks who make money off of like settlement and effectively fund administration or transfer agent like services, I think are more at risk. So like, look, the way I look at tokenization is formatting. Formatting matters. So formatting matters because as an example, like let's say I invest in a startup and I sign a SAFE agreement, right? And I sign a PDF document, and maybe I get like a share certificate on Carta, right? Like I can't, that PDF document that I've signed, that's safe, it sits on my like local email server, and it doesn't talk to any other of my assets. Like it doesn't talk to my assets in my stocks in my Fidelity account. It doesn't talk to my Coinbase account. It doesn't talk to my on-chain wallet. It's not interoperable, right?
Right.
Same with my house, like the title to my home, right? That's not interoperable. And that's why like most assets like are not interoperable with one another. And that's why, by the way, like I still personally track my assets in like a spreadsheet, an Excel spreadsheet. I was actually recently at a conference, and I asked like the audience, I was like, raise your hand if you track your assets, personal assets, like in a spreadsheet. And
no one
like,
uses mint.com anymore, I guess, or they got a bot and they shut down the service. Something happened there, no?
yeah, like no one solved this like aggregation interoperability problem because all of these assets are in separate silos. So I think the beauty of like formatting is like it moves all of these through tokenization. You basically move all assets into, they all have their own QSIP, and those effectively they're all interoperable with one another. You can see them, and that's where securitization comes in because one, it unlocks use cases like cross-margining because everything's in like one uniform kind of dashboard database, but also securitization because blockchains are really efficient at like fractionalizing things.
100%. I fully agree.
You can move them around.
All of these debt securities, especially ABS markets, should be on chain. It's programmable money. Can enforce the waterfall programmatically.
Exactly. So that, yes, all the like payment waterfalls and excess cash flow sweeps and amortization payments and interest payments, that can all be very easily automated. The actual settlement of the asset. So, I mean, if you're settling a distressed bank loan, that can be T+20 settlement. Like on chain, it's like it's effectively a atomic settlement.
Well,
and then
it's interesting because on the back end, there's still a verification agent, there's still a transfer agent, there's still an ATS. So what you're saying is, hey, look, there's user experience value, like your dashboard aggregation, but over time, that should start to chip away and replace the actors that you need in the back end to create not just user experience value, but reducing costs in the system.
Right. Yeah. So like exactly. So I think there's like a cost takeout story, right? I think you still need, like, if you look at like Securitize, they are a transfer agent, but they're able to do it more efficiently because they're kind of using tokenization. But I also think, and I think this is a key point, is that there are two other, like, I think, big advantages of tokenization. So one is transparency and auditability. So when you're talking about like CLOs or ABS, or even like banks, like the beauty of having assets on chain is you can actually, they're auditable, they're on an open ledger, so you can see the risk. And I would say if you can see the risk, like usually like financial crises happen because you can't see the risk, and then there's like a bank run, right? Like if people knew that, like, First Republic had like enough money to meet like withdrawal requests, and like there wouldn't be a run on the bank. But
blockchains are the new balance sheet. I agree.
Exactly. And so that transparency and auditability, I think, is critical. The second point is that you can actually hold these assets sovereignly. So with tokens, you can hold them outside of banks, brokerages, and custodians. And I think this is, and maybe this is a longer term thing, because I still think with tokenized real world assets like BlackRock, like any, capital group, if they're buying tokenized treasuries, they're still probably going to hold them with like Anchorage or Fireblocks. But the ability to, I think, directly take custody of an asset yourself is
it's incredible. I mean, we've relied on banks for millennia. I mean, banks are biblical. That's that old as a concept. But yeah, you can secure your savings and wealth through cryptography without having to rely on a counterparty. That's a transformational concept.
Oh, I mean, and it's this kind of thing that like people are like, oh, why does that matter? Well, it doesn't matter until one day it matters, and it's like the only thing that matters. And so if you want to like withdraw, like if you want access to your assets, like there's a gatekeeper if you hold them with one of these parties. So I think it really matters in emerging markets where maybe there's like less stable geopolitical financial structures. And so I think that's
what happens. Look at the bank runs we saw. I mean, I think it actually matters more here. In fact, I mean, as you know, there's, especially for crypto natives, and you were kind of hinting at this earlier, there's a strong preference for self-custody. There's a segment of the market, that's what they care about. And if there's an easier onboarding experience to others that have those kinds of call it like libertarian values or self-sovereign values, you could see some growth there. Most people will value convenience, though. Most people are going to say, just give me convenience. Robinhood's convenience. I don't care about the fact that it's centralized.
Right. But I think if you're the concept is very novel, of like, if you're in Argentina, you can have, if you have a mobile phone, right? Like, and I think 6 billion people have a mobile phone. You can basically be your own bank. I can hold dollars on here. I can hold tokenized treasuries on here, and I can cross borders with all of my net worth on my, on a mobile device, or just like with a password. And that is like, that is pretty novel and important. So
amazing soft power for US dollar. Yeah. Go ahead.
What was that?
No, you're right. It's amazing. It's like we're exporting the US dollar. It's amazing. It's a new form of soft power. It's actually between soft power and hard. It's like hard power, military, soft power, culture. Now we have like money, programmable money. It's in Argentina. Argentina can't stop it. It's on an app. Extraordinary.
it can't be stopped. It's very
Yeah,
interesting.
yeah,
And by the way, the last thing I'll just say on this like tokenization point is there's with like AI agents that could ultimately be most financial requests, I think in the future, like wire money, deposit money, buy this, that, will be run through some form of like agentic AI. Um, uh, uh, Blockchains are truly like purpose built for AI agents because they don't care that the user interface is complex or non-intuitive, and they care a lot about programmability, and they care a lot about 24/7 access. And AI
yeah,
agents cannot open bank accounts, right?
yeah.
Only humans or companies
Machine to machine transactions are coming, and
are
they're
coming.
ideally suited for this. Yeah,
Ideally suited for blockchains. And so I think that kind of like the future we're investing behind is one where you'll still have asset managers, you'll still have banks, but probably in a diminished capacity. You'll have trillions of dollars of stablecoins on chain. The 600 trillion of global assets, like a very large portion of them will be on chain. And they will move 24/7 with an internet connection globally, programmably, and AI agents will probably be serving the users directly. And I think most of activity on blockchains will not be like metaverse or gaming, or it'll be mostly finance, like mostly just capital markets stuff, like payments, insurance, structured products, send, receive, like basic stuff like that, because it candidly works a lot better on
internet
blockchains.
capital markets are coming. No, I agree. Internet capital markets are coming, and yeah, creating a capital market by, for example, taking the present value of someone's labor income and turning that to a streaming asset, which you can now tokenize and then sell to an institutional investor who's now underwriting this new kind of consumer credit risk. Then it gets rated. I mean, that's more things like this happening, and that's going to create lending opportunities overseas. It's an exciting time.
We're basically like speed running kind of capitalism in a sense, because now that you're when you're on a blockchain, one, it's like open source and global, and there's permissionless innovation. So the whole like smorgasbord of different financial products can be created and traded pretty, and so there's like a lot of experimentation. And like, I mean, one new big financial primitive that we've seen are like prediction markets. Like anyone can spin up a market on anything on a blockchain that trades 24/7 and has global liquidity.
Insane.
That's incredibly powerful.
I think you were an investor in one of these prediction markets, I want to believe, right? So
Poly market.
Amazing.
Poly market, which is the largest one.
Last question for you. I could go on for hours, so if you want to stay, go for it. Last question for you. Robinhood and Coinbase, winners, losers, neutral, hard to say. Given where we are now, looking forward, do they have more at risk or more opportunity ahead of them?
So I'm bullish on both companies. I'm quite bullish on both companies. Obviously, they both trade at like different multiples and like have quality of earnings.
Different levels of the stratosphere. It's like higher, they're relatively, it's like 60 times 50 plus earnings, right?
Right. What I like about, they're both trading at like kind of growth or momentum oriented multiples.
Right.
So what I like, so Robinhood is obviously, they have like what they have going for them is they have this like seamless user interface that's cross asset class. And they offer the full range of banking services to their customers. So they have, equity, options, crypto. They recently acquired a wealth management platform. They're serving like the Gen Z demographic. They are basically, they have credit cards, debit cards. I think Robinhood may have 9 businesses that have over 100 million of ARR. The numbers, like I love looking at their quarterly earnings presentation just because literally every chart it's just beautiful. It's like up and to the right. And the other tailwind they have is they're truly dominant in Gen Z, and Gen Z is getting the beneficiaries of this very, very large wealth transfer from boomers.
So
and now they're obviously building in crypto with tokenization, stablecoins, Robinhood chain. So they, I think, are in many ways really like arguably better positioned in certain ways than Coinbase. Now, where Coinbase has an advantage is they have Base, which is like one of the most popular, if not, it is the most popular layer 2 by users and by most metrics. They have like, their native wallet stack. They have, a meaningful kind of equity stake in USDC, which I think is really, really valuable. They have much deeper kind of like, I would say, regulatory muscle in crypto than Robinhood does. I believe they're much more global than Robinhood is, if you look at like the composition of their revenue. So they're competitive. They're like at first we're like kind of separate and parallel. Now they're very much competitors. And
absolutely, they're duking it out. They're going head to head. I mean, Coinbase wants to get into equities, and the value prop you articulated for Coinbase, really their edges are developer oriented. They're picks and shovels oriented, where Robinhood is focused on that end user experience and that target customer focus on Gen Z.
Right. And by the way, the other distinction that I forgot to mention is that Robinhood doesn't really have like an institutional customer base today. It's like basically fully consumer. Coinbase has a very large, like most of Coinbase's volumes are institutionally driven. They have Coinbase Prime is quietly a very, very incredible business within Coinbase, where they offer, basically borrow, lend, custody, trading, API access, a whole host of other kind of Prime-like services. And actually, if you look at Coinbase's earnings yesterday, they were, the market didn't like them. They were very soft on like transaction revenue, but a bunch of different metrics. But their subscription and services line item, their revenue line item, actually like meaningfully inflected and continues to be very strong. And a lot of that is due to institutional, adoption. I believe almost every single 10 of the 11 Bitcoin spot ETFs custody with Coinbase, and also do a lot of their buying on Coinbase. And then a lot of these digital asset treasury companies are also doing their custody and buying on the Coinbase Prime platform. So, Robinhood does not have that same institutional presence today. So, yeah.
Just they're configured differently for the future. Actually, on that point, thoughts on the treasury companies? Are we late cycle on them? Are the MNAVs starting to compress? Obviously, you've seen a long list of these go public via SPAC or whatever else. There's still more to come. You've seen prices pull back, sometimes immediately on the day of offering. My view is I think you need a leader for each chain at best. You need the Coke, maybe you need the Pepsi. I don't think you need RC Cola and all the rest. But how do you think about it?
Yeah. So I agree with you. I think that like what happens is like capital markets are like copycat machines. So like when something's working, like everyone copies it. So, you see this in crypto and DeFi, right? But you also see it in like public markets. So right now, people just saw like MicroStrategy, trading at this big premium to NAV and saying, well, and they also see like these penny stocks pivoting to buying crypto. Day one, their stocks pop. So it's natural that like people see that they're not going to sit idle. They're going to say, oh, we're going to do it too. And we're going to do it slightly better. Is it really better? No, these are like perfect substitutes, to use like an economic term, for the most part. And so I think like there are 150 public digital asset treasury plays today. I think that number's growing by like 20 to 30 per week. We could spend literally all day on the phone with bankers, like seeing like
looking at the next deal.
Looking at unlike digital asset like number 52, right?
The play is to get pre-IPO access with no lockup and the ability to sell immediately. If you have that, then you have alpha and you have an edge. If you don't have that, you got to really wonder where your edge is.
100%. So I think you can structure these as basically heads you win, tails you break even. So if you get in like a pipe at like 1x NAV, If you're structurally long the underlying asset, you kind of earn the beta return plus an amplifier tied to like the NAV premium. So it makes it a great, I think, interesting proposition for like these pipe investors. But I wouldn't necessarily be buying these things in like a big MNAV premiums in open markets. Now, I'll give you like kind of one caveat, which is, I've been a MicroStrategy skeptic for many years. And you actually would have been better off buying MicroStrategy common stock than buying Bitcoin spot. Like it's outperformed because what they're doing is two things. Like they're, selling at the money equity, at a big premium, and then using that to buy more Bitcoin. And so they're increasing Bitcoin per share. That's one. And then two, they're issuing these preferreds and convertible bonds and using the proceeds to buy Bitcoin. This is mostly like non-recourse leverage. And very low cost leverage. And MicroStrategy has kind of like preferred access to capital markets, just given its scale. It's the largest convertible bond issuer in the world. And I think it's the largest at the money equity issuer in history of capital markets. So, and it's about to get added to the S&P 500. But like crypto treasury number like 62 does not have that same economy of scale. And so my general view on this category is like, it's interesting, I think, for pipe investors, some of these names. And to your point, if you're like the first, if there's like a de facto vehicle for a specific token backed by that foundation or that founder, maybe it's king made to a certain extent, but I wouldn't want to be a number 2 or 3. But then I think the other opportunity will come in 2026 or maybe later this year, when a lot of these vehicles, I think, will trade below NAV. And I think there's an opportunity to buy some of these names below NAV. And some of these teams can sell the underlying asset and do buybacks of their stock. Or you can buy these and then you can short the underlying digital asset and hedge out like effectively like kind of the beta, the delta risk on the underlying asset itself. So I think that from my perspective, these are great instruments to just trade. And like there's going to be money lost and money made on them like through the cycle.
Yeah, hopefully we get the next Grayscale, GBTC ETHE discount play in 26, 20.
I know you were like very, you were like,
yeah, we were. So were you. I noticed you were as well.
Exactly. We were like less publicly, but you were putting out like very, insightful commentary on that we were following. So, but yeah, like I think these are like all basically a bunch of like Grayscale like vehicles, but the big difference is obviously Grayscale didn't want to offer redemptions because they were earning 2% on management fees, which was way above market. So there was this principal agent problem versus like here, you are aligned with the management teams in the sense that like you own shares and they own shares and you both want to maximize. There's no like management fee component here, and you can do share buybacks. So I think these are better from that standpoint.
Right. I love it. It makes a ton of sense. I think this is a great conversation. We covered a lot of ground. We talked about the macro implications of stablecoins, future of payments, credit intermediation, US dollar funding from stablecoins, emerging market penetration, Robinhood, Coinbase, Visa, MasterCard, tokenization. And, I think what's great is that, I think half of my followers follow for crypto and the other half follow for equities. And I think both criticize me for the other content. But what's interesting is they're probably both wrong and both halfway wrong and halfway right. But, I think this conversation, I hope, shows the audience like, you're very sober-minded and clinical. You're not dogmatic about how you look at these opportunities. You're like, yeah, look, there will be a discount to NAV here. It's not going to end well for many of these. There's an opportunity to participate there. Yes, the big banks will probably do well here, even if we don't want them to do well. But that's just the reality of how the field is set today. Well, thank you for your time. Any concluding remarks or thoughts? Anything you wanted to share that we didn't touch upon?
No, I mean, this was a great conversation. I really enjoyed
every minute of it. So for folks following online, you can listen at Lumina Non-Consensus Investing on YouTube, Spotify, wherever you enjoy your favorite podcast. Thanks again, Ben. Until next time, be well. Make it a great weekend, folks.
Take care.
Yep, take care.